Today on InvestTalk, we look at how leverage in real estate can cut both ways. Then we discuss the market movements today. We also answer questions about JD.com, McKesson, and more. And at the end, I look at if the Chinese stimulus will be able to fix their economy.
This is InvestTalk, independent thinking, shared success.
Now, our main focus point today is about leverage within the real estate sector. And this can be applied more broadly, but we'll stick to kind of the real estate space in general. And that's because it can be a more simple way to break down the fundamentals. And in many ways, leverage is misunderstood. There's a lot of negative perceptions about leverage because obviously during the financial crisis, you had blowups. Because the underlying fundamentals of the assets were not there, right? The ability for the people to pay on the mortgages that they took out wasn't there because there was not any, they didn't substantiate the income claims, right? And so everything was built on quicksand. So there's certainly some truth behind the idea that, debt creates more risk. But there's a corollary to that it can also create more profit as well if the underlying fundamentals are solid. So when you're looking at debt analysis kind of anywhere, you have to be able to parse out the underlying fundamentals of the asset, underlying fundamentals of the business. Now, in the real estate sector, it's the asset, right? What is the underlying fundamentals of that asset? In the equity space, it's what's the underlying fundamentals of the business. Because leverage can be sustained in any company if the business is sound and it can withstand different cycles, up markets and down markets. Now, in the real estate sector, it's very common for, especially like REITs, publicly traded REITs, to have some level of debt. It's a very capital intensive business. So to say, hey, they don't have any debt to go out and acquire quality assets, well, that's probably something that it's a fool's errand, right? To think that you can just go out there and find a bunch of REITs that have no debt. Now, there are some REITs that have been around a long time that have very low debt. Because over time, they've taken their cash flows and they paid down debt and they still have quality assets. Now, there are two REITs that are good examples of this. One is Vornado, which is a low debt, low leverage office REIT. Another is a fairly new REIT, NexPoint Residential, and it's fairly new to the public markets over the past 10 years or so. And it's highly levered. But it's an apartment REIT. Now, during the COVID crisis, the market sold off NexPoint because it had a lot of leverage. And Vornado didn't really sell off much. But as time went on, NexPoint rallied a lot because the market started to realize that leverage didn't matter much because the apartment business was a very good business. Their cash flows were steady. And in many ways, the value of their underlying assets were going up. And therefore, that leverage didn't matter. In fact, that leverage was a good thing. Whereas Vornado is the opposite. Low leverage, but the value of their underlying assets were falling because they were so focused on commercial real estate, office real estate, in the big cities. So the moral of the story here is that you can't just look at debt ratios and think that you understand the entire picture. Debt can cut both ways. Now, the first thing you have to understand about any level of debt is what is the carrying spread of that debt. So in the real estate sector, we typically say you want the cap rate, meaning the return you're getting on that piece of property to be higher than the cost of debt. You want that spread to be positive. And that's a fundamental of a balance sheet that you want to look at, right? If you have a leverage on a low return business or a low return asset, that can eventually crumble under its own weight, because the return on that underlying asset is not enough to really sustain the debt payments. Meaning all the profits just go towards interest and not enough to the actual paying down of the principal. And this can be applied to, once again, any industry, not just real estate. So in the office market, property values went down 20 to 60% in some markets. Whereas, once again, apartments continued to do well because demand was solid, supply was not oversupplied, and ultimately it was a very good place to invest in. So the bottom line is leverage does matter, and it's great to have a clean balance sheet. But what's most important is the underlying quality of the business. And this goes back to what I say with dividends, right? It's nice to have a good dividend, but can that dividend be supported? Just like leverage, right? Can that leverage be supported by the underlying asset? If you're ignoring that, then you're going to make a lot of mistakes in the investment world. Let's take a quick look at the market today. It was another positive day, although large cap growth did end up down a little bit on the day. You had the best area, Morningstar style box, actually mid cap core and small cap value up nearly 1%. So pretty solid day. We continue to kind of march higher on the S&P, up 23 points today, 40 basis points. The NASDAQ was up 60. The Dow was up 62 basis points. So, it was a pretty interesting day. Gold continues to march to new highs. That is certainly a newsworthy event that no one's talking about. Interest rates were up a little bit. So the 10-year was up slightly in yield. And you continue to see that, the Fed rate cut has been the buy the rumor, sell the news type of event that we've been talking about. And it just goes to show you that, hey, you can't just sit here and assume that, the Fed cuts rates are going to go down. The market front runs these type of events, and you're getting that type of move on over the past week or so. What are the big movers today? Let's see. Amazon was down a little bit. Walmart down nearly 2%. Exxon down nearly 2%. Eli Lilly down about 1.5%. Those are the big movers on the downside. Qualcomm was up 2.5%. Wells Fargo up 5%. Let's see. Dell was up 5% today. Accenture up 5.5%. Those are kind of the big movers in the S&P 500. The Mag 7 didn't really move much besides, I guess, Tesla down over 1%. So those were the market moves for the day, and we continue to grind. And we're going to get more economic data next week that will color, what the market starts to think about the Fed policy going forward. The market started to price in a pretty dovish Fed, 50 basis point cut potentially next quarter, or next month, or I think that's November actually. Yeah, there's not one in October. There's one in November, early November, then one I think mid-December. The last two. Tomorrow we do get the core PCE numbers, so that is one that the Fed follows probably the most. So that will give some more credence to whether the Fed is going to ease policy or not, and continue to ease policy, shall we say. And that will probably be a market mover, right? And so we'll see what that comes in at tomorrow.
Hi, Justin and Luke. I was hoping you guys could do me a favor and look at a company called CNA Financial, ticker is CNA, and just tell me what your thoughts of it are. If it gets a thumbs up, maybe a price target, I would appreciate it. Thank you very much. Great show. Thank you.
All right, looking at CNA. This is in the insurance business, and it's been in a nice, solid uptrend. It's pulling back a little bit now from about $52 a share. Now it's down to about 40, about 48.85 at the close today. And frankly, it's a healthy pullback. Nothing really, no problem with it. Still above the 100-day moving average and continues to march higher. And that's because earnings continue to march higher. They're up 53% last year to $4.71. Up only 4% this year, 7% next year. So, growth has slowed down, but overall their business remains very, very solid. And I like these type of businesses. I like insurance, and everyone gets caught up in tech companies and everything. And frankly, there are so many great businesses out there across different industries. And this is a solid one. It's in the property and casualty insurance space, and it has 5 segments: specialty, commercial. It has life, group, and corporate insurance as well. And they're worldwide. It's about a $13 billion market cap. Very solid balance sheet. Free cash flow about $2.3 billion. Hey, that's a good free cash flow yield. Return equity 14%. That's good, but it is at an all-time high. It's trending higher. I like that profitability. What is it doing with that cash flow? Well, it is buying back shares recently, so I think that's a positive. Overall, I'm going to give this one a thumbs up. I like the industry. The chart is solid. It has a good balance sheet. It's doing the right things by shareholders. Nice 3.5% dividend yield that certainly, based on current cash flows, can be supported. Now that dividend does look like it goes up and down. There are special dividends, and it looks like what they do with that cash flow is pay out those big special dividends. So I'm going to give CNA a thumbs up. Thanks for the call. And I hope you've been telling your friends about the InvestTalk audio podcast being available in video form over on our YouTube channel. And we get questions submitted over there. And question says, McKesson has been beaten up lately. Is this a buying opportunity? And the simple answer is, yeah, I think it is. We actually have owned McKesson for clients, and we just started to pick up a little bit more on this move. It is into some decent support here. And, it's just a very, very solid business. Price right now is $479, but earnings next year are supposed to be $35.75. $35.75. So if you go based on forward-looking earnings, you're talking a mid-teens multiple. Not too bad for a business that is very, very high quality. Another one of those names where a lot of people might look at the price tag, $450-something per share, or $478 per share, and they think, oh, that's expensive. Well, not when you compare it to its revenues and its cash flow, right? Its free cash flow is $3.2 billion. Their market value is $62 billion, so about a little over 5% free cash flow yield. Return on invested capital is 70%, 70. So very, very profitable there. They pay a dividend and certainly could raise that dividend. And what are they doing instead? They're taking that cash flow and they're buying back shares. So returning capital to shareholders. So we like McKesson and think it's a buying opportunity on these dips. Here comes a live call. We like these because it gives us a chance to interact with our listeners. So let's talk with Jim from Houston asking about bond funds.
Hello, sir. I just want to thank you so much for your program. You've really helped a lot over the years, and I want to thank you for that. I heard the other day Luke was talking about starting to transition more to bonds, and I've been looking at. I've had a lot of money in Schwab's SWVXX, their mutual fund or their money market account, and I've been thinking about the BNDC. It's kind of a fund of funds, and I was wondering what you thought about that as an alternative, kind of to transition to.
Okay, so this is the FlexShares Core Select Bond ETF. It has an expense ratio of 35 basis points. So, not super low, but not super high either. Kind of middling on the cost side. And let's see, this is a fixed income fund. Its duration is at about 5.5 years. So it's an intermediate fund. It is rallied, but it's kind of, I think a lot of that that duration risk is behind it, meaning you got a lot of that rally from 20 all the way to about 22.80 at the close today. So I think the duration is okay, but I think you're a little late to the game here, to be frank with you. It's trading at, or the bonds that it holds are all investment grade, pretty much, only a little bit below investment grade. So you're not taking a lot of credit risk here. You're extending your duration a little bit, but I think you're a little late to the game, because if you look at what's happened with bonds since the Fed cut rates, what's happened? Rates have gone up. Okay. And that shows you that either two things are happening. The market got ahead of itself, and it's priced in way too many cuts going forward, and or it's starting to worry that inflation will accelerate next year. And if you look at break-even rates, that is true. That is, the market is pricing in higher inflation going forward. And so you don't want to be layering on duration after this run. I think you're too late. Now, if you see rates rise once again, or you see the inflation rear its ugly head a little bit, right, reaccelerate to 4 or 5% or something like that, and the Fed go into a tightening cycle and you see rates rise, that's actually when you want to buy it, right? It's so funny that money flows out of bonds just at the worst time, and now bonds have rallied. Everyone's talking about rate cuts. You're late to the game. The market has priced this in already. Now, if you want to go and buy individual bonds, that's how we do it for clients. We're buying individual bonds. So we're taking some duration risk, but we know what that is. We know what the holding is. We can hold it to maturity, et cetera. We can take the coupon payments and reinvest that at higher rates if bond rates do rise, et cetera. And that's, I think, a better way to play the bond market right now. I wouldn't go and buy a bond fund after this run, because I think most of this run in bonds is kind of behind us.
Okay. Thank you so much for your help.
No problem. Thanks for the call. Let's go take another live call from Jordan, just south of me in Dana Point, asking about RBB.
Hey, Justin, how you doing? Thanks for taking my call.
Yeah, of course. You're looking at RBB. You looking to buy it, or do you own it?
No, I own it. I own a small portion. It's like less than 1% of my portfolio. It's just kind of sitting there, not really doing anything. I'm doing well in other stocks. I'm wondering if I should just sell it and reinvest it somewhere else.
Well, it's certainly still an uptrend, so technicals are fine. But what I don't like is that earnings peaked out in 2022 at $3.33. And now they were down 33% last year to $2.24. It's supposed to be down 30% this year to $1.57, and then up a little bit next year to $1.70. But that's below pre-pandemic levels when they earned $1.94. And it's a regional bank, very small, $405 million market cap, 24 branches, and it looks like California, Nevada, and is that Louisiana, I think? So it's just a small regional bank, and I don't love those. So I think based on the trajectory of the fundamentals and being it so small, I think you have much better opportunities out there. So I would certainly sell, even though the technicals are fine. I am seeing some divergences on the MACD. I just don't like the underlying fundamentals or the area that this is operating in. So I would move on and find something better.
Right on. Thanks for your advice.
No problem. Thanks for the call. Now, let's go and talk a little bit about those bond funds, okay? Which the previous caller had asked about. And it's some pretty interesting trends happening within the bond fund space. And it's the fact that so far this year, and this goes back to, money flows in usually at the worst times and flows out at the worst times. But so far this year, investors have poured nearly $190 billion into U.S. fixed income ETFs this year. That's up into August. And that's according to Morningstar, 50% higher than that time last year. Okay. So a lot of money flowing into these these ETFs, the bond ETFs. And the caller just asked about one. And that's a big trend, a new trend, kind of out of your traditional actively managed bond mutual funds. Okay. And so a lot of that money is going into your traditional index bond funds, which I've always said, not the greatest place to be. Indexing, it works fairly well in equities, but it doesn't really work that well in bonds. But people are still throwing money that way. In addition, they're also throwing money at a non-core type of bond funds, mainly specialty managers and private equity, hedge funds, private debt markets, etc. And your traditional active managers in the mutual fund space, even in the ETF space, they're the ones getting pressured. They're the ones seeing more of the outflows, even though their returns are still very good. ETFs have grown from $200 million, this is in the bond fund market, $200 million in 2003 to $14 trillion at the end of August. Think about that. It's a huge growth. And on the other side, over half of all management fees in the investment industry will go to alternative asset managers this year. That's up from 28% in 2003. Think about that. Alternative asset managers. And I will tell you this, alternative assets don't have a great track record. They don't. Now, alternative assets are very broad, so it's hard to say, which one is, which segment is the culprit. But in general, it's crazy to think that in aggregate, this alternative asset space takes up half of all industry fees. Just shows you how many hidden fees there are in these private funds that, the big brokerage houses are pushing to their clients. Now, these trends are for a few reasons. There's been a major change since the Fed lowered rates dramatically to zero for, roughly 15 years. And investors started to rethink how their portfolios were composed. And so a lot of them, so the share of US bond managed in the ETF format surged from 21% to 28% just recently, since the Fed started raising rates. So a lot of money is flowing that way. Active bond fund ETFs had a median expense ratio of 40 basis points. It was 65 basis points in the mutual fund space. So a lot of people are moving that way for that reason. So it makes sense. But the top 6 listed alternative players within the bond market saw a whopping 21% increase in new money into their credit funds in the previous year up to June of this year. All the other traditional firms, only 1% growth. So a lot of money continues to flow to these alternative spaces because of the amount of the big players, the Morgan Stanleys, Merrill Lynch's of the world, that are pitching these to their clients, mainly because they get big fees, commissions, kickbacks, etc. And these credit funds, they're not very transparent. They kind of say what their value of their funds are worth. There's not a lot of, because they're private. Remember, they don't change hands very much. It's not like the public markets where, these assets are being traded regularly. And these funds are getting more risky. Why? Because banks around the world are being pressured. Basel III, all of these new capital requirements are putting on them. So what they're doing is they're slicing up the risk. Does this sound familiar? Slicing up the risk. CDOs. Now it's CLOs, collateralized loan obligations. And what they're doing is they're keeping the safest part of the debt instrument, and they're selling off the riskiest portion of their debt to these private credit funds. And so that's why you see, the yields on them are pretty good, but they're taking a lot of credit risk. And ETFs are becoming even more important in the space because of this, because they're the primary source of bond liquidity, because that's where the most of the money is flowing within the public markets. So your traditional fund families, they're having trouble. That's why if you look at some of the publicly traded ones, they're getting a hit from both sides. Not only seeing outflows on the equity side, the actively managed equity funds into passive ETFs, but that's happening in the fixed income space now as well, and then also into the private credit space because of the structures and the promised returns and the kickbacks that a lot of these big brokers are getting. So it's kind of a barbell approach. Kind of the safety of one of the issues with those ETFs that are indexing is that they hold so many treasuries. And that middle space, there's not as much money, and it's actually starting to be where you can pick up a lot of the best opportunities. So pretty interesting what's happening within the bond market, and so much money flowing to those two sides and kind of shifting the way our capital markets are financed.
Here's a quick reminder. The newest InvestTalk Wealth webinar is happening soon, Tuesday, October 8th at 11 a.m. Pacific Time. The InvestTalk Wealth webinar will focus on effective strategies for managing your 401k and enhancing your retirement savings. Go to investtalk.com and sign up for our upcoming Wealth webinar, October 8th. It's free to attend, but you must pre-register. And please tell your friends.
Hello, I had a question about JD stock. Currently, it is about 4% of my portfolio, but now it has gained up to about 6%. I'm thinking about maybe $40, once it reaches $40, about selling the entire thing. And my question was whether or not I should just trim or sell the entire amount. I know that there are some comments made about the situation in China regarding their population, and just wanted to know if you think JD should be trimmed or completely removed. Thank you.
All right, looking at JD.com, and this is a Chinese retailer offering a wide selection of products via JD.com. They're kind of the Amazon of China. And the stock's up big recently, and that's because of the stimulus, which I'll talk about probably after the break. But it just started to move. It's moved from 28 all the way to 38 now in just a few days. But it's been down in its luck for a while. It peaked out over $100 per share back in 2021 and hit a recent low around $35. So I think there's some potential upside, frankly, just because this move just started. Now, is this move sustainable? I agree with you. You talked about the demographic issues. I think there are a lot of deeper issues in China that which I'll talk about after the break, that will probably prevent this from, returning to $100 per share. So I do think trimming this as it rallies is the way to go. But as I say many times, the truth is somewhere in the middle. You don't have to sell all of it. I would slowly trim into this rally. Let me give you a number here. 53. That's where I would trim it.
Hey guys, this is Art from Tucson. Today I'm calling in picking up on a theme that Luke laid out, I think it was recently on the podcast, saying that bonds should rise in their value as interest rates are lowered. And along that theme, I'm looking at a PIMCO fund. It's a PIMIX, PIMIX. And this is a diversified fund of multi-sector bonds. It has a pretty good yield. And I'm thinking it might be a good time to get into this fund because the bond prices should rise and the value of this fund should go up, giving capital appreciation as well as a good, healthy yield. Wondering what you think about it, and I'll listen on the podcast for your answer. Thanks.
All right, look, the PIMCO PIMCO Income Institutional Fund, PIMIX is the symbol, 50 basis point expense ratio. So, lower than the average actively managed mutual fund, bond fund. So I think that's fine. You have a little over 6% yield, 4.2%, 4.2 years is the effective duration. And, as I said with the previous caller, it's rallied a lot already. It bottomed around a little under $10. Now we're at almost $11. And so it's rallied nicely along with that yield. I think there's some potential upside, but it's fairly limited because of the recent run. Once again, the market is priced in a healthy level of Fed rate cuts already. So I don't think there's much upside. Now, the yield is fine. I like that it's a 4-year duration. That's not super short, but it's not long either. I think it's in the wheelhouse. Kind of 3 to 4 years is probably what I would like to see. And historically, it's a very good fund. 5 stars for Morningstar. I like that it's diversified. It's not just focusing on one sector. It's fairly well diversified. Not a lot of corporates though, which I would rather see a little bit more corporates. But it's a fine fund. I have no issue with it. Once again, I just don't think there's a lot more upside for bonds. A little late to the game already. Okay. Now let's talk a little bit about China. And China is starting to stimulate its equity markets. It's really unprecedented, really. And they unveiled on Tuesday a $114 billion war chest trying to boost the stock market. It's going to help lending to asset managers, insurers, brokers, and even some listed companies to buy back their stock. Okay, and this is all about boosting their equity markets. And they said if it works, it could double or triple the amount that they're allocating towards this. So this is a pretty big bazooka, really aimed at a market that's been down for a while. The China CSI 300 index and the Shenzhen listed shares are down more than 40% since 2021. Now they're up 4.3% on Tuesday, 2.1% on Wednesday. Let's see, what was FXI up today? Yeah, that was up, 7-8% today. So it's been a big move. And it just shows you what government intervention can do. So I bring this up because do I think there's more room to run with this? Yeah, probably in the short term. But can this change the economic trajectory of China? Probably not, right? This isn't fixing the demographic issue. It's not fixing the fact that companies are no longer investing in new manufacturing facilities there. Right? The direct foreign investment is fallen to a trickle. Their housing market is drastically oversupplied. And drastically oversupplied with today's population, much less, a population that is going to continue to shrink for the next few decades. So you're going to see that housing market continue to struggle. Now, is this going to give a place for Chinese citizens to now invest their money? At least for the near term, are they going to try to ride this wave? Probably. But this isn't a long-term fix for their economy. So if you want to jump on the trade, fine. But know that it's a trade. And know that you're not going to pick the top, right? You ride it, get a good return, but you be the first to jump off. Let's just say that, okay? So understand what this is. It's not fixing the underlying issues. I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. And please tell your friends about our upcoming wealth webinar coming up on October 8th at 11 a.m. Pacific time. And it's all about enhancing your retirement savings and effective strategies for managing your 401k. Independent thinking, shared success. This is InvestTalk. Good night.